Stocks stalled Tuesday after a record run-up over the last few days. Now, Keith, have we reached a pivotal point right now? Has the markets topped?
In my opinion, no, the market has not stopped. I think we got more to go in this rally. While we're at all-time highs, we actually picked up a couple of very interesting momentum indicators last night, which tell us that the buyers will come in and they will continue to seize control of this market, and the sellers will have to just kind of sit on the sidelines. It's not unusual to see this kind of action. We've been up for 7 straight days, hitting all-time highs each day. So take a pause, consolidate a little bit, but I think we'll march higher, and you'll see the S&P set an all-time high here probably this week.
So if you're an aggressive trader, if you want to use the aggressive method to approach the markets, what methods should you deploy from here?
Well, you can do one of two things. I mean, if you think the market has topped out, then you should be layering in shorts each time the market ticks up a little bit, and as we approach the high on the S&P 500. If you're long this market and you continue to believe in this market and it will go higher at the end of the year, you can invoke a strategy called a collar on your portfolio, which means you effectively buy a put contract to protect your downside risk, and you sell a call option out of the market. Both of those would be out of the market. So you effectively receive the premium on the call option that you've sold to defer some of the costs on the put, and you're limited on your downside risk. You may get blown out of your portfolio as a result, but you'll lock in your gains when you do something like that.
And what if you're a more risk-averse investor? What methods should the risk-averse investor be employing right now?
Similar strategies. People can do what's called, if you think the market is topped out and maybe pulling back, you can do something called a covered call, which you can take your long positions and go ahead and write call options against it. So you bank a little bit more revenue and premium on that, and if they go down, you will be taken out of your positions, but once again, you've locked in your gains. Or the other thing that people do is they've got such a large gain in this market. If you bought high beta stocks or just regular market stocks like spiders in January 2012, you're up 24–25% in this market already. Why not take a little bit off the table, lock in your gains, and start playing with house money? So people start doing that as well.
So overall, would you suggest a more aggressive or more tempered approach right now?
I would suggest the more aggressive approach that we talked about right now. So doing the collar option on it. Again, I think that the market is probably due for some sort of correction. I don't think it'll be a 20% correction in here once we hit that all-time high. Maybe we see 5 or 10%. The markets have consolidated so much so far, and the volatility has been stripped out of the market. I don't think we're going to see those really wild swings and moves no matter what happens. So you put the collar on, you bank some premium on the call that you put out there, you protect yourself on the downside, make it pretty tight, and then you just let the market run from there.
And also, you know, there are some market participants who are still worried that there's not much margin for error right now in the markets. Looking ahead, we've got data tomorrow in the coming days. Is that something that, we should be a little bit concerned about?
Always worried about the economic data, and you're right, the markets have gotten stretched a little bit and are particularly temperamental at this point in time. You could say that any data point that's far off from the expectations could have the effect of pushing the market pretty dramatically one way or the other. The participation in the markets has still not been terrific. We've still seen low volume days as we grind higher. We've got some interesting data points coming later this week, as PPI tomorrow and then CPI. And also industrial production is a very important number, and the number underneath that is the capacity utilization. The reason that's important now, I won't give you a broad-based economics lesson, but the reason that's important is we've seen overall that the productivity inside of the American worker is getting just about as far as it can go. The capacity utilization is just about as high as it can be. So what that means is that we've stretched the American worker to get out just about as much as we can. When that happens, two things either have to occur. Companies need to hire more workers, or they need to pay existing workers more money to work longer hours. Both of those effects have wage inflation impact, and then could start to see some more inflation inside of the broader economy, which then may force the Fed's hand a little bit more. So those are very important data points that we've got to keep an eye on. If they come in too broadly away from the consensus one way or the other, you could see a market reaction. But again, as I was saying earlier, I think volatility has been stripped out of the market so far this year, and we're in a pretty tight range. I'm not sure it's going to have a 20% impact, but a mild impact.
Thanks, Keith. This is Andrea reporting for TheStreet.